Hello, here we are again together. Okay, now we're going to be covering chapter 16, and this is another financing chapter. More definitions, more memory tips. Put on your memory hat, and let's start talking about real estate financing practices now. Not the principles, but the practices. So let's get going, and hopefully you'll understand it a little bit better than reading the book over and over again. Introduction to the real estate financing market. How is the market set, the real estate financing market? Well, the Federal Reserve System, also known as the Feds. They divide our country into 12 Federal Reserve districts, each served by a Federal Reserve Bank. They dictate how much money the banks have to keep in the bank and how much money they can lend out, etc., etc. Reserve requirements. Each member bank must keep a certain amount of assets on hand as reserve funds, unavailable for loans or any other use. They have to protect customer deposits and provide means of manipulating the flow of cash in the money market. So if the Federal Reserve stated that as of, let's example, June 1st, all banks have to keep $1 million more on hand than what they currently have to, do you think that might hold back or might possibly increase loans? Higher interest rate, or maybe they have to maintain double of what they currently have to maintain. What do you think interest rates would do? Interest rates probably would go up, correct? And they would lend less. Increasing reserve requirements decreases the amount money banks have to lend. Interest rates rise, consumers spend less money, slows the economy, slows inflation. If they decrease the reserve requirements the banks have to have, the bank has more money to lend. Interest rates usually will go down. You will spend more money. The economy picks up. Inflation rises. Discount rate is the rate charged by the Federal Reserve when it lends money to its member banks. The prime rate is the short rate charged to a bank. The largest, most credit-worthy customer will pay the prime rate. Prime rate is strongly influenced by the Fed's discount rate to its member banks. Now when we talk about the mortgage market, we talk about different players in the mortgage market. You have the primary market and you have the secondary market. The primary mortgage market is made up of lenders that originate the loans. For a lender to give a loan must generate enough income to be attractive as an investment. That's why sometimes when you have very bad credit, you may still be able to get a loan, but you may pay a lot higher interest rate, okay? Because it has to be attractive. Investors' income is generated from two sources. Not only does the lenders make money on the interest rate they charge us, or finance charges collected at closing, such as origination fee and discount points, or recurring interest, the interest during the loan, they also basically create income on who services the loan, if they service the loans, such as collecting payments for another lenders, accounting, bookkeeping, preparing insurance records, etc. The primary market is made up of different players. Your primary market, where loans are originated, are made up of thrift institutions, savings and loans, commercial banks. When we talk about commercial banks, we mean Citibank, Chase, Bank of America, etc., etc. Insurance companies many times are used for long-term real estate loans. Credit unions, pension funds, they usually have large amounts of funds for large investments. So if you're buying something, a very large investment, endowment funds and investment group financing, those make up our primary market. Also, in your primary market, you'll have mortgage banking companies and mortgage brokers. Key thing to remember, mortgage banking company, they lend their own money. They lend their own funds. They retain the loans permanently, or sometimes they will resell them on the secondary market. They sell them, why? So they can free up money and then they can lend again. So they make money not only on the loan origination, the discount, and the interest originally, but then they package them up and sell them. And then they have more money to lend, and then they lend more money, package up and sell, etc., etc. Mortgage banking, they lend their own funds. Another one in the primary market is mortgage brokers. It's like you as a real estate broker, okay? Mortgage brokers, they do not lend money. All they simply do is bring the borrower and the lender together for a fee paid either by the lender or the borrower or both. Just like you as a real estate broker, once you get your license, you are going to be bringing buyers and sellers together. Okay, you don't buy the properties, you bring the two parties together, the landlord and the tenant, etc. Okay, so think of mortgage brokers bringing two parties together like you will be bringing two parties together. Then once the loans are funded, once you close on the property, then you have the secondary mortgage market. Government-sponsored enterprises where loans are bought and sold after they've been funded, after they've been closed. You have Fannie Mae, or also known as Federal National Mortgage Association, Fannie Mae. It's not the candy store. You have Freddie Mac, also known as Federal Home Loan Mortgage Corporation, FHLMC. That's a mouthful. Similar to Fannie Mae, they buy pools of mortgage loans from lenders, and they are used as collateral for mortgage-backed securities that are sold out in the global market. Ginnie Mae, also known as your Government National Mortgage Association, Ginnie Mae, starts with a G, government loans, okay, is a division of HUD. It's a wholly owned government corporation within HUD. It guarantees mortgage-backed securities using FHA and VA loans as collateral. So they deal with FHA and VA loans. Now we're going to go through a few financing techniques. And there may be more in your textbook, but we're going to talk about a few you need to know. Straight loans, also known as interest-only loans. You ever hear of an interest-only loan where you only pay interest and at the end of the loan you pay all the principal? During the height of the market a few years back, a lot of people were taking out straight loans. All they did was pay interest, and then the market bombed. And then they still owed all that principal on their property. A straight loan divides a loan into two amounts, principal and interest, to be paid off separately. Only interest is paid during the term of the loan. The principal is all due at the very end. So if you financed $150,000, when you're done with this loan, you still owe $150,000. It's also known as an interest-only loan. Or another name you may see once in a while is a term loan. So that's one of your financing techniques. Another one is the amortized loan. This is the standard one most people are familiar with. Okay, the loan too is divided into two parts. It's divided into interest and principal. It's fully amortized. The entire debt is paid at the end of the term. So every payment you make, portion goes towards interest, portion goes towards principal. In the beginning, if it's a 30-year loan, in the beginning 15 years, most of the time you're paying on your mortgage payments, most of the time you're paying, most of it is interest. When you get down to your last 15 years, you're paying more and more towards principal. At the end of the term, if it's a 30-year loan, it'll all be paid in full, unlike an interest-only loan. It's your most traditional type mortgage loan. Then you have an adjustable rate mortgage. It's like an arm. It can go up or down or up. It's a loan that originates at one interest rate and fluctuates up or down like your arm during the life of the loan. Adjustable rate mortgage loans will have rate caps. The rate cap is like a cap. It stops. If you have a hat on your head, it stops your hair from popping up or blowing away. The rate cap limits the amount of interest that may be charged. Okay? You have annual rate caps and aggregated rate caps. Annual is how much, or periodic rate caps is how much it can change period to period. Aggregated is how much it can change during the life of the loan. And the rate is tied to an index. Okay? Payment caps are set a maximum amount for payments. Adjustment periods establish how often the rate may change. Our mortgage security agreement will have what they call an escalator clause. Think of an escalator in the store. It can go up or down when you get on the escalator. Another very common mortgage loan today is a reverse mortgage. See, if you, a property owner, take out a mortgage loan, as we've talked about, you are known as the mortgagor. You're the owner. The lender, the bank, is a mortgagee. You, the owner of the property, pay the lender every month, principal, interest, sometimes taxes, insurance also, PITI payments, P-I-T-I, based on the mortgage loan, okay? Well, when it's in reverse, the loan is based on the equity the homeowner has invested in the property. And here the lender, the mortgagee, who is the lender, pays the mortgagor, who is the owner. This type of loan is available for senior citizens on fixed incomes to draw equity they have built up, sometimes in a lump sum, sometimes in payments. So how do they pay off what is due? Well, if they ever sell the house, they have to pay off that reverse mortgage loan, or if they die, it has to get paid off. So it's a reverse loan. The mortgagee, the lender, pays the mortgagor. Balloon payment. Those are periodic payments that are not enough to fully amortize the loan over a period of time. Basically, many times the loan may be amortized over 30 years, but you can get a lower interest rate because you have to pay off that loan within 5 years of taking out the loan. It balloons. The balloon pops after 5 years, 7 years, 10 years, based on the agreement. Non-recourse loans, those are basically for people who have very good credit, have very large down payments, many times used in commercial properties. They're not holding you, the borrower, personally responsible. Usually involves high equity loans. They hold basically the property responsible. Loan programs. How much you put down based on the loan is called a loan to value. What is the loan compared to the value of the property? Okay, loan to value is the ratio of the loan or the debt according to the value of the property. 80% LTV, loan to value, means a down payment. You're putting down 20%. Here's an example for you. Let's say the value of the property is $100,000. You're putting down $20,000, which is 20%, correct? So if you're putting down 20%, what is your loan amount? Your loan amount is $80,000, right? Easy to do that even in your head, which means the loan to value is 80% of the value. If it's a low loan to value, that means it's a small loan. Low loan to value, small loan, high down payment. If you have a high down payment, you're a lower risk to the lender. It's opposite what your brain thinks. You think high loan to value, basically you're thinking a high loan. Well, high loan to value is a large loan, low down payment. So just keep those two in order. When you have a high loan to value, that means you're putting small down payment, usually less than 20% down, and you're a larger risk to the lender. Conventional loans, less than 20% down, you also have to pay private mortgage insurance. Most of the time, conventional loans in history have been viewed as the most secure loans because many times their loan-to-value ratios were the lowest, usually 80% of the value of the property or less, with at least 20% down. Credit scores are very important when you're purchasing property. A credit score can range from 300 to 850. Guess which one is better? 850, not 300. And your credit history is very important. If when lenders are giving out a loan for greater than 80% of the value on a conventional loan, that means you're putting less than 20% down, they require the borrower to secure insurance from a private mortgage insurance company, PMI, private mortgage insurance company. And that company insures the lender in case the borrower defaults. Okay? Why do they require it? Because you're a higher risk. FHA insured loans. FHA insures the lender. One thing you definitely need to know is FHA does not lend the money. The lender makes the loan. FHA simply insures your lender against default by you. FHA loans cannot have prepayment penalties, where a conventional loan can. FHA loans will have a prepayment privilege, which you win the lotto, you can pay it off without any penalty. 203B FHA loans are your most common type of FHA loans out there, where you can finance up to 97% of the purchase price, 3% down, better than renting. 203K, those are rehab loans. and other loan programs through FHA. Key thing here you need to remember, FHA never lends the money. They simply insure the lender against a loss. You can have umpteen FHA loans in your lifetime. It has to be owner-occupied, but you can take one loan, pay it off, take another FHA loan, pay it off. They're simply insuring the lender. Another loan out there is VA guaranteed loans. Today in our marketplace, we have a lot of veterans. They've done well service for our country. VA is authorized to guarantee homes for eligible veterans who meet certain time in service criteria and their spouses. VA guarantees the lender from loss. They're not guaranteeing the borrower. Again, like FHA, VA does not lend the funds. VA loans cannot have a prepayment penalty. They have prepayment privileges. VA and FHA loans also can be assumed, so they will not have a due on sale clause. So your main three types of major loan programs are conventional, FHA, and VA. Conventional can be a conventional loan or a conventional insured loan. A conventional insured loan means you have less than 20% down. FHA and VA loans are also known out there as non-conventional loans. They're not conventional. They're not conventional loans. They're their own type of loans. A veteran also needs to have a certificate of eligibility. That states the maximum guarantee to which the veteran is entitled to. Certificate of reasonable value, also known as your CRV. Certificate of reasonable value, when you purchase a regular property, well, the lender will order an appraisal to make sure the property is appraising out to what you're paying for. But when you're taking out a VA loan, a VA lender will basically order an appraisal, but they call it the certificate of reasonable value. States the property's current market value based on a VA-approved appraisal. It places a ceiling amount of the VA loan allowed for the property. If the purchase price exceeds the CRV, the certificate of reasonable value, you, the veteran, can pay the difference, or you can renegotiate it. But they will only lend with no money down based on the CRV. And VA loans are the only true loans with 100% loan to value. You go downstate in Illinois. If you live downstate Illinois, there are agricultural loan programs. Farm Service Agency, FSA, formerly known as Farmers Home Administration, Federal Agency of the Department of Agriculture. Though they offer programs to help low and moderate income families to purchase and operate family farms or purchase and improve single-family homes in rural areas. I know in the Chicagoland area we don't have rural areas, but you don't have to drive too far for that. And you can basically get a loan that will help. Farmer Credit Service, they provide loans to farmers, ranchers, rural homeowners, agriculture cooperatives, rural utility systems. Just be aware if you happen to see these again. And then you have Farmer Mac. And it sounds like we put our Levi's on and started going out to farmland, right? It's a government-based enterprise that operates similarly to Fannie Mae. Like, you know, Fannie Mae buys and sells loans in the secondary market. So what other financing techniques do you need to know? Well, there are more out there. One is a purchase money mortgage, typically known as owner financing. It's a note and a mortgage created at the time of the purchase to make the sale possible. It can be a first mortgage held by the owner of the property or a second mortgage. So you can go to Bank of America and take out your first mortgage, but may not be enough. So then the owner may finance the rest of it. Okay, so the second owner held the lien would have to disclose to the first mortgage holder. Another term that you should remember, these are 15 and 16, chapters 15 and 16, as I told you, many definitions, many terminology. Okay, you need to know the definitions in chapter 15 and 16 very well. A package loan. Think of a box. wrap up this box with wrapping paper and everything. Inside the box, throw all the real property, all the personal property, and take a loan out for it. Includes personal property and the real property, all included in the loan. Okay? Another loan we're going to talk about covers more than one parcel. So you take a blanket and cover all your furniture with one blanket. That's a blanket loan. Developers many times have blanket loans. Covers more than one parcel. Blanket loans will have a partial release. So if you're buying new construction home in a new development, the first house the builder closes on, they can pull out from under the blanket and close it out. If they did not have a blanket loan on this property, then if they were building 100 homes and they're closing on home number 1, they'd have to pull that out from under the blanket, refinance the property, and remortgage 99 homes. And then they close on house number 2, take it out from under the blanket, refinance the entire loan for 98 loans. It's like 100 bottles of beer on the wall, right? But this allows them to close one at a time and they do not have to refinance the loan. Wraparound loan. These were very popular when interest rates were very high, 14, 15, 16, 17, 18%, 19%, 20%. Some homeowners had a loan that was lower, but they wanted to get additional financing, so they go to a second lender. The second lender would acquire their first loan, maybe that was at 8%, and they'd give them a loan for maybe 11% or 12%, and then that new lender would take over their first loan, and they'd make one payment to the new lender. The new lender would pay the original lender. It's known as a wraparound. You wrap one loan around another, but I'm going to caution you. If the first mortgage loan agreement with the lender has an alienation clause where you transfer interest, no wraparound loan can occur. Because once that lender takes over the original loan, interest has been changed. Due on sale, alienation, pay up. Another one should be familiar with, it's open end. It's open. It secures a note against any future advances. Like a line of credit. You have a credit card, you have a max you can use on your credit card, and you pay it off, you can reuse it, pay it off, reuse it, pay it off, reuse it. Well, you can have an open-end loan like that on your property, a second mortgage. Basically, you can take out a loan for $50,000, only take out $10,000 of it, but you still have $40,000 to use for future use. Eventually, you have to pay it all off. Construction loans many times are also known as intern financing. Okay? Lender commits to a full amount of the loan but disperses the fund in payments, draws during the construction of the property. Buy down loans were happening back in time. That's where people would buy down the interest rate up front by paying points. They may pay more points and buy it down. Maybe for the first year it would be a 3%. The second year it would go up to 3.5%. The third year and then on it go up to 4%. But you're going to pay discount points up front. Sale-Leaseback. You all know Walgreens? Walgreens? This is a very familiar way. This is where the land and the building are sold to an investor and leased back from the investor by the seller who continues to conduct business on the property. See, Walgreens, the way they were to expand throughout our country several years back is they started buying land. They bought the land. They built the store. They stocked up the store. They opened the store. Then they put the store with the land on the market for sale with them as the tenants, usually for the next 25 years. So currently, most Walgreens you go past or go in to visit, the store is a tenant. Somebody else owns the land in the building. They have a lease. So they were the owner, and now they become the tenant, the lessee. Okay? Home equity loans, they sometimes are a good source of funds using up the built-up equity in your property. So home equity loans, you have certain laws, financing legislation, truth in lending, Regulation Z. They require credit institutions to inform borrowers today of all finance charges, the true interest rate, before the transaction is completed. And it applies to credit secured by residential property. It does not apply to commercial or agricultural loans. A creditor is considered anyone who extends consumer credit for more than 25 times each year, or more than 5 times each year if the transaction involves a dwelling as security. Your truth in lending will have 3-day right of rescission by the transaction. So if you're refinancing your home, they will not fund your loan until you have 3 days whether you're going to change your mind or not. Okay, this right does not apply to residential purchase money on a first mortgage. So when you first buy a home, you don't have 3 days right of rescission. Closing, it's yours. Congratulations. There are penalties for violating truth in lending and Respa. With truth in lending, now it's also known as TIL, the TIL. It's buyers know before you buy. Okay, it has advertising requirements. Your annual percentage rate, APR, has to be stated in an ad. Have you ever looked at an ad in a paper? Most of your car loan ads, and it says, monthly payments to own this car, $200 a month, and it has a little asterisk. Then down in the real fine print, it tells you how long the loan is for, what the loan amount is, what the interest rate. Okay? The only number based on your truth in lending that can stand by itself is your APR rate. Okay? If you put one figure other than the APR rate, like how much the monthly payment is, you have to put all figures. Or if you put down, own this property with as little as $1,500 down, well, then you have to put all in. You have to put the interest rate, the length of the loan, your APR rate, everything. Another law lenders have to follow, we have fair housing laws to follow, but lenders have to follow Equal Credit Opportunity Act. This law prohibits lenders or anybody else who grants credit, credit card companies, anybody, from discriminating against the credit applicants based on race, color, religion, national origin, sex, marital status, age, dependence on public assistance, etc., etc. They cannot discriminate. So let's take this couple that's 85 years old. They want to purchase a property. Can they? Oh, yes, they can. But they want to take out a mortgage loan. And they qualify. And he's a veteran. He wants to use his VA eligibility. Can he? Can he take out a 30-year mortgage loan being 85 years of age? Yes, he can. Can the lender discriminate if he qualifies? Absolutely not. Respa, it's encompassed today with the TIL, with the truth in lending in that. Basically, Respa is designed to ensure that the buyer and seller are fully informed of all settlement costs. There's a cost, they have to know about it. The law requires that a standard statement be shown, all expenses relating to closing. This is for residential properties with financing. If I'm doing owner financing, I don't have to follow it. If it's a commercial property, it doesn't have to follow it. So that's a lot of definitions there in your Chapter 16, is it not? So let's go take a breather, go rest, relax, take a nap, and I'll see you in our next chapter.